Something meaningful is developing across global markets at this moment, and it is being presented incorrectly in most cryptocurrency discussions. You are hearing terms like disaster, breakdown, and fear, largely connected to Japan's bond yields and interest rate adjustments. The headlines are sensational, the delivery is emotional, and the conclusion many immediately reach is that this automatically signals the destruction of risk assets such as crypto and XRP. That is shallow analysis. Yes, Japan is important. Yes, increasing bond yields matter. And yes, this applies short-term pressure across worldwide markets, including crypto. But if fear is where your thinking stops, you miss the real opportunity embedded inside this transition. Markets do not reward those who react fastest. They reward those who recognize which phase they are experiencing. Japan's decision matters because it directly affects global liquidity. For decades, Japan has served as the least expensive source of capital globally. Funds borrowed in Japan did not remain inside Japan. They flowed into U.S. stocks, European instruments, emerging economies, and yes, crypto. When Japan raises rates, that inexpensive liquidity begins reversing. Capital is withdrawn, leverage unwinds. Risk assets experience strain. That element is real. What is not real is the idea that this is a sudden, unpredictable shock no one could have seen coming. This unwind has been building for years, and more importantly, it never unfolds in a straight line. Liquidity cycles never do. In the near term, higher yields tighten financial conditions. They force investors to deleverage. They generate volatility. That is why crypto responds so aggressively. Crypto is among the most liquidity-sensitive markets on Earth. When liquidity contracts, crypto reacts first and hardest. But this is where most people misunderstand the situation. They treat short-term liquidity pressure as if it determines the long-term result. It does not. It defines the reset. Every major liquidity cycle in history looks terrible while unfolding. The 2008 crisis did not feel like opportunity in real time. It felt like total system failure. What followed was the largest monetary expansion in modern history. Pain came first. Response followed later. And that order matters. Japan increasing rates is not the conclusion. It is the pressure stage. Pressure reveals fragility, breaks leverage, and pushes policymakers into decisions they would rather avoid. When stress turns systemic, governments and central banks do not sit idle and allow collapse. They intervene. They always have. This is why focusing only on immediate downside ignores the broader context. The real question is not whether liquidity tightens. It already has. The real question is how the system responds once pressure becomes politically and economically intolerable. And that response is where assets like XRP re-enter the discussion in a very different context. Right now, XRP will not avoid volatility. Anyone claiming otherwise is misleading you. XRP is a liquidity asset. When liquidity tightens, it experiences pain. That is the cost of early positioning. But that same sensitivity reverses when liquidity expands again. Short-term fear and long-term positioning are not opposites. They are two halves of the same cycle. This is why anchoring emotionally to today's price movement or this week's macro headline is dangerous. These moments are engineered to shake conviction, not reward comprehension. Most people will not zoom out far enough to realize that what feels like chaos is actually part of a larger reset. The market is not breaking, it is repricing risk. And repricing risk is uncomfortable by design. To understand why Japan's bond yields carry this much weight, you must understand Japan's role in the global financial system over decades. Japan has not merely been another economy, it has effectively functioned as the world's cheapest funding engine. Ultra-low rates transformed the yen into a global financing tool. Capital was borrowed cheaply in Japan and deployed into higher-yielding assets elsewhere: equities, property, bonds, and eventually crypto. This is what is known as the carry trade. When yields remain low, this structure operates quietly in the background. When yields rise, the mathematics shift instantly. Suddenly, servicing costs increase. Positions that made sense under cheap money no longer do. That is when capital returns home, not gradually, aggressively. This is why rising Japanese bond yields do not only impact Japan, they ripple outward. Liquidity is pulled from global markets. Leverage unwinds and risk assets reprice. Crypto, being one of the most liquidity-sensitive markets in existence, reacts violently. Here is the piece most people miss. This behavior is not new. We have already watched this pattern unfold repeatedly. Each time Japan meaningfully adjusted policy over the past year, crypto responded with sharp declines. Bitcoin drawdowns of 20 to 30% following Japanese rate changes are not coincidences. They reflect the same mechanism at work. Liquidity tightens, leverage breaks, and price declines until forced selling exhausts. That correlation is real. Ignoring it would be irresponsible. But correlation does not mean permanence. What is occurring now is not a permanent removal of global liquidity. It is a rebalancing phase. Capital is being forced to confront years of distortion created by ultra-loose policy. This process is painful, chaotic, and volatile, but it is also necessary. This is where people leap to extreme conclusions. They see pain and assume collapse. They see volatility and assume system failure. In reality, this is how systems cleanse themselves. Debt that cannot survive higher rates is exposed. Over-leveraged structures unwind. Weak balance sheets fail. That is not a flaw. That is the mechanism that enables the next phase. Because once pressure escalates enough, policymakers face limited choices. History makes this clear. When financial stress becomes systemic, governments and central banks intervene. They reduce rates, they inject liquidity, they expand balance sheets. They do this not from generosity, but necessity, allowing cascading collapses politically and economically unacceptable. This is why timing matters. Japan raising rates today causes short-term pain. That pain does not resolve immediately. It compounds over months. Borrowers struggle, institutions wobble, markets tighten further, and eventually something breaks sufficiently to force response. That response is never deflationary long-term. The 2008 crisis demonstrates this perfectly. Immediate reaction was fear and collapse. Long-term result was historic monetary expansion. Liquidity did not vanish. It returned larger, broader, and more aggressive than before. That is the pattern markets follow. So when people say this is bearish for crypto, they are only telling half the story. Yes, tightening liquidity is bearish now. But the resolution of tightening cycles has historically created some of the most bullish environments for scarce, liquid, globally transferable assets. That is where XRP re-enters relevance. XRP does not benefit during panic. It benefits during the liquidity response phase, when capital re-enters the system, when settlement efficiency matters, when cross-border flows increase, and when volatility pushes institutions to seek faster, cheaper capital movement. That is where XRP's architecture becomes relevant. This is why separating short-term impact from long-term consequence is critical. Japan's policy creates volatility now. It pressures crypto. It scares participants out of positions. But it also accelerates conditions that historically lead to monetary response elsewhere, particularly in the United States and Europe, where tolerance for economic stress is lower. Markets move on incentives, not morals. If Japan continues tightening, global pressure increases. If pressure rises globally, policymakers elsewhere are incentivized to ease. That divergence is where new liquidity channels emerge. This does not make timing easy. It does not make bottoms obvious, and it does not mean pain has ended. It means the cycle is advancing, not concluding. Now connect this macro pressure directly to XRP, because this is where most people completely misinterpret events. XRP is not a speculative toy floating independently of global liquidity. It is deeply linked to liquidity conditions, cross-border capital movement, and financial stress. That makes it vulnerable during tightening. It also makes it disproportionately relevant when efficiency becomes necessary. When liquidity dries up, everything correlated to liquidity suffers. Crypto first, equities next, credit later. XRP receives no exemption because of long-term thesis. In fact, assets like XRP often feel greater short-term pressure because they sit closer to financial infrastructure than narrative-driven assets. That is not weakness, it is design. During tightening, capital retreats to safety. Risk appetite collapses. Institutions defend balance sheets rather than experiment. In those conditions, XRP is not meant to shine. Expecting XRP to outperform during global contraction misunderstands its function. But here is the critical point. The stress that hurts XRP now is what exposes inefficiencies later. Rising yields, repatriation, currency volatility, and funding strain create friction. Friction is exactly where settlement-focused assets matter. XRP was built for environments where moving money quickly, cheaply, and reliably is essential. not when conditions are calm, when they are strained. This explains why XRP cycles do not align cleanly with Bitcoin narrative cycles. Bitcoin reacts first to liquidity expansion as macro hedge. XRP reacts later when capital moves again and institutions demand improved rails. That reality frustrates holders because it requires patience. XRP often underperforms during early stress and early recovery. It moves when liquidity has turned and institutions reallocate at scale. Now consider the historical correlations mentioned earlier. Yes, Japanese rate hikes have aligned with sharp Bitcoin declines. That relationship is real. What is missed is what follows. Historically, crypto bottoms form not at peak fear, but when rate pressure stabilizes, not reverses, stabilizes. Markets do not require easing to bottom. They require certainty around tightening pace. Once Japan signals proximity to the end of hikes or markets believe marginal impact is diminishing, forced selling fades. That is when risk assets stop falling. Not because conditions improve, but because deterioration slows. That moment is subtle and uninspiring. Retail often exits there. They wait for relief, fail to see it immediately, and conclude the thesis failed. In reality, they exited during transition from panic to stabilization. For XRP, this phase is vital. XRP does not need perfect macro to bottom. It needs exhaustion of forced liquidity unwinds. Once that occurs, downside compresses sharply, even if upside takes time. Another uncomfortable truth is that returning liquidity does not distribute evenly. It flows where regulation permits, infrastructure exists, and counterparties are trusted. XRP's thesis relies on those alignments. That is why regulatory clarity, institutional access, and settlement use cases outweigh short-term price. This is why comparing XRP to purely speculative assets leads to mistakes. Those bounce earlier because they are thinner and emotionally traded. XRP moves when size matters. When XRP struggles during tightening, do not read failure. Read confirmation that it behaves like liquidity infrastructure. The danger is confusing patience with denial. Assumptions must be reassessed honestly. Risk must be managed. Conviction does not mean ignoring macro reality. It means recognizing cycle phase and not demanding outcomes the phase cannot deliver. Now address the counterbalance. Global liquidity does not disappear. It shifts. This is lost when people fixate on one nation or one rate move. Japan tightening is pressure, not the whole system. Markets are global and responses unsynchronized. When one economy tightens aggressively, others adapt. That adaptation may not appear as immediate cuts. It begins with targeted liquidity, balance sheet changes, and political pressure. Early signs already exist. China illustrates this. While Japan tightens, China injects liquidity to support growth. That liquidity does not remain isolated. Even with controls, domestic easing influences behavior and flows. It does not replace global liquidity, but it softens contraction. The United States also plays key role. The U.S. does not tolerate prolonged instability, especially in sensitive political periods. Bond stress, equity declines, and credit tightening quickly become political issues. Political issues invite monetary response. This is why assuming Japan tightening equals multi-year collapse is dangerous. Tightening creates stress, and stress invites intervention. Timing is uncertain, sequence is consistent. Typically, tightening exposes fragility, markets reprice, something breaks, then policy shifts. That shift may begin small. Markets move on expectation. This matters for crypto and XRP. Crypto does not require perfect conditions to recover. It requires directional liquidity change. It needs belief that worst is past, not that best has arrived. When that occurs, capital cautiously returns. When it does, it seeks liquidity, efficiency, and compliance. XRP fits there. XRP is not first risk on asset. It becomes relevant when cross-border movement resumes, when volatility demands efficiency. This is why XRP lags early recovery. It is not built for anticipation. It is built for scale. Tightening cycles also impact participants unevenly. Weak players fail first. Strong institutions survive. Survivors shape next phase. They demand better systems. That is how systems evolve. Japan's tightening is a global stress test. It forces reevaluation of leverage, risk, efficiency, uncomfortable but necessary. Systems that reduce friction gain relevance after stress. When asked why care about XRP now, answer is not comfort. Expect volatility and frustration. That is cost of positioning for response phase. Liquidity will not remain constrained. Question is where it flows. Assets aligned with efficient regulated movement benefit. Strip fear and headlines away, and this is not unprecedented. Liquidity cycles apply pressure, break weakness, force adaptation. Japan's rising yields are not crypto's end, they are tightening phase. Tightening hurts first. Crypto feels it hardest. Pain is real. Pain is not failure. Every reset follows same order. Liquidity tightens, assets sell off, leverage unwinds, sentiment collapses. Then policymakers act. Economy cannot function under prolonged contraction. Timing matters more than emotion. Markets bottom when fear stops worsening. That moment feels exhausting. XRP is deceptive here. It is not built for panic. It is built for rebuilding. If focused only on weeks ahead, this environment feels hostile. Zoom out and liquidity relocates. When it returns, it seeks better rails. That is XRP's thesis. This is not blind holding. Risk management matters. Reassessment matters. Biggest mistake is abandoning thesis because timeline disappointed. Markets punish impatience more than being early. You do not need perfect prediction. You need clarity. If you believe XRP serves efficient regulated finance, liquidity stress is part of path. If not, that is valid. Decide through analysis, not fear. And finally, this content is educational only and not financial advice. Always research and consult licensed professionals before investment decisions.